Good morning. You are watching a live daily market outlook for Thursday, 24th of May 2012, a day after the Eurozone meeting shows markets in a rather quiet mode, but still negative tone continues to dominate as yesterday's rather informal meeting over the dinner did not give any significant results, with most of the members still keeping their own, pushing their own stories, and not still holding away from any workable solution for the Eurozone, with the pressure still remaining, especially on the block currency that hit fresh 20-month low yesterday at 125.44. As outcome of the meeting was the Eurozone surge to Greece to stay in Euro. However, news that leaked yesterday and shocked the market were that Eurogroup asked the members to start working on a plan of possible Greece's leave of the bloc and the steps to be taken in order to prevent any stronger impact on this. As said, yesterday's meeting advised by senior officials to prepare contingency plans in case Greece decides to quit the single currency, and urged the country to stay the course on austerity and complete the reforms demanded under its bailout program. After nearly 6 hours of talks held during an informal dinner, leaders said they were committed to Greece remaining in the Eurozone, but it had to stick to its side of the bargain too, a commitment that will mean heavy costs for Greece. Comments from German Chancellor Angela Merkel say that we want Greece to stay in the Euro, but we insist that Greece sticks to commitments that it had agreed to. And this is actually one of the main points. The three officials of the Eurozone told that instructions to have plans in place for a Greek exit was agreed yesterday on Monday, during the teleconference of the Eurogroup working group experts who work for Eurozone finance ministers. From the other side, the Greek finance ministry denied that there was any such agreement, but Belgian finance minister said that all the contingency plans for Greece come back to the same thing. To be responsible as a government is to foresee even what you hope to avoid. Two other senior EU officials confirmed the call and its content, saying a contingency plan was only sensible. The Euro exit would be actually pose considerable and manageable for the Eurozone in case of Greece leaving, and the challenges for its European partners, raising pressure on Athens to stick with its painful economic reforms. Greek officials have said that without outside funds, the country will run out of money within 2 months, and there remains the threat that if it crashes out of the Eurozone, other member states could be brought down too. Basically, this is one of the worst scenarios, and the possibility of domino effect in case of Greece exiting the monetary union and the Eurozone itself could have quite a bigger impact on the other countries, especially the Southern Europe countries that are in deep crisis. And most likely scenario would be the next step would be the Spain, that is number one after the Greece, as well as Portugal, with Italy also being in debt for approximately 1,900 billion euros, seen also as a threat for the European Union. That was approximately what was the outcome of yesterday's informal meeting, and more of this definitely would be seen on the end of June meeting of Eurogroup, when some more that will be the more official and formal meeting, and will give some more strong and workable results. We hope that some solutions will be found. Otherwise, we might be facing something that didn't happen so far, and the impact of such movements could be quite bad, as euro remains heavily affected by current crisis and continues to trend lower. As we mentioned at the beginning of the session, date 125.44 was a low seen yesterday, fresh 25-month low last time, levels seen in August 2010. With the further weakness of the single currency seen quite likely as completely negative, technicals and the negative sentiment that dominates in the markets keeps the downside firmly in focus, with some brief corrective consolidative action seen between the fresh legs lower that is currently underway, and not seen as just a mild consolidation before investors decide for another heavy sales. There will be nothing unless the pair breaks at minimum above 27-28 zone. That might be signaling some stronger recovery. Until then, most likely scenario would be a further weakness of the euro, as also there is no significant barriers on the downside. The last one was cleared yesterday, 126.22 yearly low, and 125.86 low of 2010 August. And now it's opening way towards 120 zone and 118.75 low of 2010, with most likely the round figure supports, round figure levels acting as supports at this point. Also, I sat today on the calendar that is due to show the releases of European PMIs, starting with the German one and then a Eurozone one that we're going to take a look now in today's calendar. As said, already released was Swiss trade balance for April. Rather disappointing result, as forecast was for increase of surplus to 1.75 billion Swiss francs compared to 1.58 billion francs of the March. Today's release showed only 1.33 billion. Germany's final GDP for first quarter came as expected, unchanged at 0.5%, and still to come in a couple of minutes. German flash manufacturing and services PMI. The manufacturing one is forecasted at 47.1, slightly better than the 46.2, the previous one. However, still below 50, a mark that indicates either growth or contraction. In this case, contraction, while services PMI is expected slightly to decrease compared to the previous release at 52.2, with the 51.9 forecasted for today. Eurozone flash manufacturing PMI for May is due 2 minutes before 8 o'clock GMT, and 46 is the forecast compared to 45.9. Still a negative tone in both, holding firmly below 50 mark, while services PMI is forecasted to stay unchanged at 46.9. German IFO business climate is forecasted slightly below the third quarter, the April's release at 109.9, with today's consensus at 109.4, and this will be basically the main focus for the Eurozone for today, with the UK quarterly revised GDP due at 8:30 GMT expected to stay unchanged, minus 0.2%. From America's weekly jobless claims due at 12:30 GMT, a slight increase seen today, 374,000 compared to 370,000 of the previous week release, while durable goods orders for April are due to show some improvement, building up by 0.5% compared to contraction of minus 0.4% of month of March. The same with the core durable goods orders that are forecasted at 1.2% today compared to minus 0.8% of the March's release. And a group of speakers later in the afternoon at 1300. We have the ECB President Draghi having speech. 14:30 is FOMC member Dudley, and the Treasury Secretary Timothy Geithner is due at 1900 GMT. And that was all for today's calendar, and we're going to take a look now in the markets and see the latest movements and the expectations for today's trading session. As said, euro remains in the steep downtrend, and yesterday's fresh weakness triggered after unsuccessful recovery attempt of 126.41 last Friday's high that were capped at 128.23 and limited by descending bear trend line of 132.82 with the break below 126.41, accelerating losses through yearly low at 126.22, figure support at 126.00, and the 125.86 low of 2011 August, dipping down to 125.44. That was the low seen yesterday, with the brief consolidation now underway, most likely ahead of a fresh leg lower as studies remain in the negative territory, and no signs of any stronger corrective action seen on the short-term outlook. Previous supports, as at 126.22 now act as initial resistances, with yesterday's consolidation top at 126.80 zone acting as the next barrier. However, no signs of any stronger correction will be seen unless 128.20 zone is regained. This is the high of 21st of May, also marking a 38.2% retracement of the move from 132.82 to the latest low at 125.44, and this seems unlikely for now, as said, a quite negative tone and the negative sentiment that dominates in the markets, with the no firm results of any steps from the Eurogroup in solving the current problem, most likely to keep the negative sentiment during the coming days, and most likely to push single currency even lower. As said, the last barrier was taken out at 125.86, and for now we have basically no serious obstacles towards 120 and 118.75 low of 2010, and this keeps quite dark outlook for the single currency, as it remains in the downtrend in past exactly 1 year from a 2011 peak at 149.38, with loss of some very significant points, now opening way for 120 and 118.75. Okay, the sterling also under pressure as fresh weakness yesterday, and dip below previous low at 157.31 cleared this level, and 157.00, dipping so far to 156.67. This is quite a risky zone for the pair, as 156.40, 61.8% retracement, and the range floors of the February-March 2012 consolidative range are now under pressure, 156.40 and 156.00, and basically the last strong obstacles that remained on the pullback from 163.00 peak of 30th of April, loss of which would open a way down towards 152.33 low of 2012, with some interim support seen at 154 zone and 153.60, but clearly there is no serious obstacles on the way down, and the likely scenario would be retest of 156.40 and 156.00 as a negative tone dominates on the daily studies, despite being in the quite extended at quite extended levels, yet no any signal of corrective action. On the lower time frames, the pair is still under heavy pressure, and no signals of any even consolidation, as 20 days exponential moving average currently at 157. That is acting as our initial resistance, capping the upside attempts. For now, there was a brief push higher from 156.67, the low of this morning, but still the pressure remains firmly at the downside. To avert further downside risk, I would say the regain of minimum 158.50 previous highs is required, but according to the current outlook in the near-term studies, this will be quite unlikely, as heavy pressure remains, especially that euro is moving lower, and fresh strength of the dollar keeps the currencies such as euro and sterling under pressure, and most likely to push them even lower, as trend remains quite negative. And as I said earlier, the negative sentiment among the investors favors the selling scenarios. Only above 158.50 would provide a short-term relief and allow for some stronger recovery, but still, as the negative tone dominates on all time frames, more likely scenario would be a test of 156.40 and 157. Before I forgot to mention 200 days moving average currently at 158.08 is actually our first barrier dynamic resistance ahead of 158.50 zone, and the only break above these levels would provide near-term relief. The dollar-yen remains skewed towards the downside, as recent recovery attempt of 79 failed at 80.13 2 days ago, and the subsequent dip lower hit levels at 79.20, just ahead of 79. That keeps the pressure at the downside, as the current brief consolidation and sideways movements remain limited at 79.50-60 zone by 55 days exponential moving average, with the cross of 20 days one below pressuring further the price. Unless 80.13 is regained, the firm pressure towards the downside keeps retest of 79.20 and 79.00 favored at this stage, with the break of 79.00 to signal an extension of the broader downtrend from a yearly peak at 17, and the possible test of next significant support 78.55 200 days moving average, and then 78.30 zone previous December 2011 range top, and 78.00 is round figure support, and that will likely signal an end of the medium-term corrective action from January 2012, when the pair bounced off 76 in the most significant corrective action seen in the past couple of years, and regained 84.17 so far, just short of our next significant barrier at 85.50 zone that marks a peak of 3rd of April 2011, and the subsequent dip lower keeps currently the pressure again, as the broader outlook for dollar yen remains longer term outlook remains firmly bearish, as we are in descent from the latest top of 2007 at 124.14, with the 75.56 historical low of dollar yen seen so far, posted on beginning of October 2011. As said, only regain of 80.00, would provide relief, with break of more significant 80.60 zone, and close to it is 80.70, 61.8% retracement of the latest down leg from 81.77 to 79.00. That will be signal for a stronger corrective action. From the other side, the Bank of Japan keeps the cards on the table for any intervention and action, as the current situation is not quite suitable for them, as this is repeating the scenario of 2011 when they intervened after the yen hit its record highs against the dollar, and to prevent further strength they took an action and intervened in the market. For now, some comments during past week from Bank of Japan officials still keep cards on the table for possible action. Of course, no firm data and announcement of this will be seen unless we see the action in the market. Dollar Swiss in the strong uptrend after clearing 95 barrier yesterday, with 95.71 seen so far, just ahead of our next upside target. Interim target at 95.45 was cleared, and our next upside target at 95.93, yearly high of 2012, posted on the 9th of January. The outlook remains firmly bullish, though overextended and overbought conditions on the daily chart might be warning for some corrective action, yet no any signal, as all indicators are pointing higher on the larger time frames. Lower time frames also keep the firm focus at the upside, with brief correction consolidation, I would say, followed the yesterday's rally to 95.71 high seen so far, with the 95.30 zone so far containing dips with the 20 days exponential moving average underpinning, and the pair currently approaching a previous high in order to resume higher, and the possible test of 95, 93, 96.00 as our next barrier. On the larger picture, this is the last obstacle on the way towards 97.70 zone. These are the 97.40, 97.70 highs of February 2011, and the 99.49 is seen as the next one, 61.8% retracement of the longer term down move from 117.30 peak of 2010 to 70.67 low of 2011, also historical low of dollar yen. On the downside, immediate support was overnight corrective action dip at floor at 95.30, ahead of 95.00 as round figure support, with the current with the recent low at 93.66 expected to contain any more significant dips. 20 and 55 days moving averages pointing higher are underpinning the current action. We just have the release of German data, so I'm gonna just briefly tell you the pardon. Sorry, that was a mistake. Anyway, let's continue with our outlook for gold. Sharp reversal of 1600, our initial target that limited the upside, and dipped to 1533 yesterday. Again approaching the critical support zone, and the pair still remains in the very slippery area despite the recent bounce higher that reached 1563 levels approximately. It's acting as a stronger resistance at this point, with the 55 days exponential moving average limiting corrective action for now, unless we see a firm break above 1570 level that was previously support and the break point. I would say the likely scenario would be further weakness and the test of this critical support at 15-20-30 zone that was now acting as a triple bottom, but still vulnerable, and a possible break here to open way for a more significant extension lower, with the 1500 and 1478 seen as the next targets. And finally, the crude oil still in the steep downtrend as extending losses below 90.00, 89.28 was seen low seen so far, posted the early hours of today, with negative tone continuing that continues to dominate and push the price lower. The talks between Iran and the U.S. nuclear watchdog are entering in the second day, and quite a good possibility of finding a result and of finding an agreement and possibly solving this problem that appeared a couple of months ago would be further pushing the price lower, as will reduce the current shortage of the oil in the market. That is approximately 300,000 barrels per day, according to the U.S. Oil Agency. Also, yesterday's release of U.S. crude inventories that show the build of the crude stocks for the 9th consecutive week sees that reduced consumption of the oil worldwide, and especially in light of signals of weakening Chinese economy, that is number 2 consumer of the energies, are still quite bearish for the oil price. And as we said yesterday, 90.00 was our target, and that was reached and cleared. That might open way for a now next significant level, Fibonacci level 61.8% at 88.54, as a firm bearish trend and quite negative fundamentals keep strong pressure on the crude oil price. That was all for today. I would like to thank you all for attending, and we'll be back tomorrow morning at the same time, 7:00 GMT, with the latest news and analysis. I wish you a nice day and a very successful trading. Good luck.